The Rock Center for Corporate Governance, changing the debate about corporate governance.
Hi everyone, welcome. I think we're going to go ahead and get started. Hope everyone was able to get enough to eat out there. My name is Beverly Moore, and I'm a third-year student here at the law school, and also co-president of the Stanford Law School Federalist Society, which is one of the sponsoring organizations for tonight. So I just first of all wanted to say welcome and thank you for coming. We are excited to have three great panelists tonight to talk about a topic that I'm sure everyone is very interested to hear more about. So I first of all just wanted to thank the various sponsoring organizations. As I mentioned, the Federalist Society and the board's been very involved in helping plan this event. Also the American Constitution Society. I don't know if they have some members here or not, but thank you to them. And then lastly, the Arthur and Tony Rock Center for Corporate Governance has played a huge role in planning this event, so I wanted to thank them. For those of you who don't know a lot about the Rock Center, it's a joint initiative with the law school and the Graduate School of Business here at Stanford. And they put on a lot of events around campus and throughout the community with a goal of sort of changing the debate on corporate governance. So a big thank you to them as well. I just wanted to go ahead and introduce the panelists. The way it's going to work tonight is each of the panelists is going to speak for about 10 minutes or so on a particular area, aspect of what's going on in the economy right now. And then at the end, after they've each spoken, we'll give them each a couple of minutes to sort of respond to each other and discuss anything else they wanted to talk about. And then we'll open it up to Q&A from the floor. And we have microphones here set up. So when we do open it up for Q&A, I don't think the microphones are turned on just yet. You'll just have to turn them on at the bottom, and we'll get going with that. So the first speaker will be Professor Mike Boskin. Professor Boskin is the T.M. Friedman Professor of Economics here at Stanford, and is also a senior fellow at Stanford's Hoover Institute. He is also a research associate for the National Bureau of Economic Research. He served as chairman of the President's Council of Economic Advisors from 1989 to 1993. And he's the author of over 100 books and articles. So, our second panelist will be Professor Darrell Duffy, who is the Dean Witter Distinguished Professorship in Finance at Stanford Graduate School of Business. He's been on the finance faculty here at Stanford since 1984. He's also authored many books, and his research mainly focuses on credit risk, asset pricing, fixed income securities, and over-the-counter markets. And lastly, we have Professor Joe Grunfest, who teaches here at the law school. He's the W.A. Frank Professor of Law and Business here. Professor Grunfest is an expert on capital markets, corporate governance, and securities litigation. Before joining the law school in 1990, he was commissioner of the SEC, and he also served on the staff of the President's Council of Economic Advisors as the counsel and senior economist for legal and regulatory matters. And he's also founder of the Stanford Securities Class Action Clearinghouse. So a warm welcome to each of our panelists, and we'll open it up to them. Thanks for coming.
Thank you, Bev. Is this on? Can everybody hear me? Is this now on?
Yep.
Okay. Okay, good. We've decided to sort of divvy the material up so we're not, in our introductory remarks, overlapping immensely. Well, obviously there'll be some. I'm going to talk a little bit about the economy and how we got here and what's perhaps likely to unfold. That will focus some on housing markets and financial markets. Darrell will then pick it up from there, focusing on financial markets. You're going to spend some time on interbank markets and derivatives in general, and Joe batting cleanup, third in this case rather than fourth because there are only three of us, has a variety of things he's going to add on the legal side and others. And then we're going to throw it open to questions. Okay. And remember, there are no silly questions, there are only silly answers. So put the onus back on us. The economy probably entered recession well before the chaos of the last month. Employment's been shrinking since January. Real consumer spending's been declining since May. Business spending's been declining for the last 2 or 3 months. Industrial production globally is under strain. And there was some chance that without this additional sands in the gears of the financial system, in addition to what was already there, that we might narrowly skirt recession. The way it's measured, it might not have been long enough or broad enough. It might have been so concentrated in finance and construction that we would narrowly avoid the technical definition of a recession. That's probably unlikely now. Most people think the quarter that just ended was around flat and expect the fourth and first quarters to be negative. Most people are asking the question, how severe and how long? So it might be useful to give a minute or two of history for those of you who haven't been thinking about it much lately as law students. The American economy in the last 25 years was in recession between 5 and 6% of the time. It had two very brief, historically mild recessions. That's the best macroeconomic performance in terms of economic fluctuations that any industrial economy has ever recorded, as near as we can tell. I mention that not because the record's about to be broken, we're about to have our third recession, but because that is one of the reasons why this great moderation, it has sometimes been called, that is part of the underpinning of a more casual attitude toward risk, in my opinion. After the recession of 2001, which started in March, some people would date it to late 2000 when there was a negative quarter in the third quarter, then we grew in the fourth, and then it started down again. The tech bubble collapse, 9/11, and so on. The economy had a slow recovery, and then by 2003, the middle of 2003, was growing strongly. That's important because after brilliantly engineering a rapid reduction in their target interest rate to 1%, the Federal Reserve, deserving substantial credit for reducing the severity and length of the downturn, in my opinion, along with the tax cuts and the natural resilience of the economy. The Federal Reserve kept interest rates low for a very long time and then raised them very slowly. The American economy was growing for 2 years robustly with negative real interest rates, inflation-adjusted interest rates. So short-term borrowing was very cheap. Money in this sense, short-term funds were in a sense being subsidized, negative real interest rates. That laid a foundation for a lot of the problems that occurred because so much lending short and borrowing long occurred. Simultaneously, there were many trends going on in the financial markets and system. The growth of the non-bank or shadow banking system, which grew to be larger than the traditional banking systems, people would argue. Less lightly regulated, even more opaque. Even more thinly capitalized. Investment banks, very thinly capitalized. Some others, even more thinly capitalized than them. And certainly relative to lightly capitalized banks. We had an explosion in derivatives. Darrell focused on that more. Each of which designed to splice and dice risks and lay them off to people who are most accommodative of them and reduce the cost, and with some substantial benefits, such as lower mortgage rates. But the securitization process, et cetera, this grew, and there wasn't much regulation of it, perhaps wisely. There wasn't much full understanding and knowledge of it. Darrell mentioned, I'm sure, a couple of two or more technical problems in the derivatives market. If not, I'll come back to it. We had a housing bubble partly as a result of the very low interest rates, and then a set of things that had gone on in housing markets and housing policy. The federal government had, for many years, starting as late as the late 1970s, but especially in the Clinton administration and then renewed in the Bush Jr. administration, made a big push to greatly expand home ownership to lower income people. Many of our institutions, we can go over them, from what went on with Fannie and Freddie, despite attempts to rein it in, letting them grow thinly capitalized, grow their balance sheets, to about 4 years ago, the Housing and Urban Development Department, in conjunction with, I've forgotten whether it was Fannie or FHA, announced a great new innovation, the no money down mortgage. Well, the no money down mortgage morphed into the no money down, no income verification mortgage, which then morphed into the no money down, no income verification, low starter teaser rate mortgage. And a lot of people then basically had to put on the lenders. They looked at what was going on, Housing prices are soaring. Housing prices went up 80%. There are a lot of different issues about how to measure them, but roughly 80% from 2002 to 2007. Personal income per capita or per worker went up in the low 20s. So this is an unsustainable rise in housing prices relative to incomes. You could do a similar analysis relative to rents, whatever you think the fundamental carrying power of those housing values would be. So people were in them saying, well, we'll get in now before they go up further, or if housing prices keep going up, we win. If not, since in the vast bulk of states, home loans are non-recourse, we just get back the keys. These were then, the mortgage originators had compensation schemes which led them to get paid by the each. They put a lot of people into homes and more expensive homes. You can argue how many people fraudulently filled out their income verification by their own accord versus the winking of the mortgage originator or the assistants or the mortgage originator filling it in. There's a lot of blame to go around here. But the bubble burst in housing markets, causing a lot of strain on the economy in households' perceived wealth. Households have been taking hundreds of billions of dollars a year out of the increased equity value in their homes and spending some fraction of it, investing some, but it gave a big boost to consumer spending. It strained with the prospect of increasing foreclosures and a deluge of foreclosures and other issues, it strained the derivative assets based on the cash flows from the mortgages, etc. On top of that, we managed to have a bad energy shock at the same time, with oil prices reaching over $140 a barrel. Fortunately, that's substantially, not fully abated. And that because America and most of the Western world and Japan are large oil importers, is like a giant tax on the economy, and the revenue doesn't even go to our government, it just gets shipped to oil producers. And this operated as a big drain, raised global inflation, made it difficult on central banks around the world to deal with, and greatly strained household budgets. So a variety of things happened simultaneously or at the same time in what I would call a perfect storm of these kind of mutually reinforcing problems that acted as kind of accelerants on each other. What do I mean by accelerants? No low negative real short-term interest rates, all this short-term borrowing by banks increasingly getting their capital from the commercial paper market rather than from deposits, financing their growth by the commercial paper market rather than deposits, these tremendous growth of lending, the ability to sustain for a long time, for several years, an explosion of very risky lending that would have the results justify the expectations on which the loans were made, only if the short-term borrowing remained attractive, open and attractive, and if the economic events, housing prices kept going up, or the economy grew strongly enough to generate the earnings for these enormous EBITDA multiple private equity deals that were being financed by the banks would pay off. Well, in my view, we basically became, segments of our financial system became insolvent, mark to market or mark to whatever market will be when things improve a little, but way below current carrying values. And we had a liquidity problem and a solvency problem. Let me just say two or three things about that. So we've had the most unprecedented policy response one can imagine. Some of it late, but massive. The Fed had a big monetary stimulus with lower interest rates, and again a coordinated rate cut quite recently. We had a fiscal stimulus, I think ill-designed, but it gave a teeny boost to the economy for a quarter or two at a big cost. We're talking about another fiscal stimulus, bringing Congress back to do another fiscal stimulus. The Fed and then the Treasury and then the FDIC through the Treasury, and they're all interacted through the government borrowing that does all this, and the Fed should be thought of as part of the government, and its balance sheet consolidated with the federal government's balance sheet for many reasons. Did a large number of credit facilities, most recently for the commercial paper market. Every time something, so the Fed went from too big to fail to too interconnected to fail in the case of Bear Stearns, to too interconnected to fail unless people are sort of aware it's likely to happen in Lehman Brothers, which blew up in their face, to now it's too frozen to wait, so we'll do a facility, because some of the core markets in our economy, the credit markets, the short-term interbank borrowing market and the commercial paper market had basically frozen up. And there was great fear that would accelerate the downturn and lead to a much greater increase in unemployment and rise in bankruptcies, foreclosures, spilling into many businesses outside of financial services. The Treasury finally came around to the view that there was a solvency problem and is now planning to inject capital in banks. In fact, it's in the 9 largest banks and would-be banks. It's already in the process of doing so, whether they want to or not. And we'll have a program that's broad to do that. The FDIC is now insuring senior unsecured debt of banks, $500 billion of which was going to have to be refinanced in the next year, and so on. So we have a real serious problem of recapitalizing our financial system. I'll just end by saying we've been in similar, not quite as severe as this or as rapid as this, problems in our more recent history, and the comparisons to the Depression are only partly valid. But in the early 1980s, when Miguel de la Madrid repudiated the sovereign debt of Mexico, we had the Latin American debt crisis. The money center banks in New York were insolvent, mark-to-market. The Fed didn't force them to mark-to-market. They were profitable ongoing enterprises. Between that, and then when we came in, we did Brady bonds to create a liquid market where they took a write-down and had a sensible market to operate in, and it sort of worked out. So that forbearance, which I think was kind of what was on the Fed and Paulson's mind originally, maybe we could make this work without an even larger government intervention or direct capital injections, worked in that case. It didn't work in the S&L case. The whole industry was insolvent in 1980 when the increased interest rates wiped out the value of the fixed-rate mortgages at that time they kept on their books. This continued. We did a whole bunch of things, increased deposit insurance limits to keep the failing institutions able to continue to have deposits and attract them. We did a whole bunch of other things, changed accounting rules, capital requirements, and so on, which greatly magnified the problem when we finally cleaned it up with the Resolution Trust Corporation. So I think there are some glimmers of things to gather from that. I think that what the government is doing now hopefully will work. I think there's a good chance. Some of it may have been occasioned by waiting and being inconsistent and confusing the market about what was going on. The transparency issue in derivatives made it hard for people to tell who was solvent. The government made it hard to figure out who was going to be bailed out. And then all the talk about the world will come to an end if this wasn't passed probably scared a lot of people. So we now have a global response and a massive increase in government's intervention in the economy. And I'll just conclude by saying, however well this works, and I think it's likely to help some, and by that I mean that the recession won't be as bad as it otherwise would be, that will recapitalize the banks, and the rate at which lending to businesses and household contracts will slow, not that there will be a big expansion of it, that it will be very important that we figure out how to exit from this in a way as graceful as the RTC, removing itself from the marketplace when its mission was done, and we get back to the fundamentals of a market economy. So I'll conclude there.
Thanks, Michael. Good evening, everyone. Michael has focused largely on the macroeconomic side of the story, and I want to go micro. I want to talk about the financial system itself, the plumbing of the financial system that we normally take for granted. We all think of, even in the mainstream macroeconomics and financial economics, we think of that plumbing as a given. You put cash in one end and it comes out the other minus some asset management fees. But it's not quite that simple. There's a lot of pipes and valves in there, and they got messed up, so I want to talk a little bit about how that happened. It goes back to something that Michael was talking about, the process of securitization, which is really at the epicenter of this credit crisis. What happened is that as opposed to the old days when you go to the bank and you borrow money, say for your house, and the bank lends you the money and is at risk if you don't pay back, as most of you know, most recently those loans are not held by the bank, they're passed on to Wall Street and repackaged together into different types of securities. It's a fallacy that it's impossible to create good securities from a lot of credit risk. In fact, you can do that if it's done properly. For example, if you get 1,000 of these mortgages for 100,000 apiece, put them into a $100 million package, you can offer someone the first 80 million, and even during a credit crisis, that's normally a pretty safe security. But this process was going so well for the last years that investors started to like these securities more and more, and they were willing to take them at higher and higher leverage, meaning maybe the first 90 million would still be acceptably treated as a safe security and rated AAA by the rating agencies. Of course, the rating agencies weren't watching the process that Michael described of bad documentation. The dynamics of the securitization business were actually contributing to the run-up in house prices, because since there was such a demand for these securities, the banks were told, hey, get more loans because we know what to do with them. And the banks were granting loans on easier and easier terms. That more and more people wanted houses as a result of getting easy terms. And it was a vicious circle that collapsed, as Michael described. Now, the model by which securitization happens in a textbook, and I've made the mistake of writing about the same textbook model, is that the bank is there to originate the loans and then distribute these packages of securities to others. Originate to distribute is the so-called technology. So they would take these tranches of securities, the safer than average ones and the riskier than average ones, and send them out to investors around the world according to their investment needs. But it didn't happen that way. The banks themselves thought that these so-called safe securities were pretty safe and that they were getting enough extra yield on them to make it worthwhile for the banks to hold on to these so-called safe securities, and they held on to them in alarming amounts, and often without proper risk management, and also with compensation schemes that were designed to accelerate this process of a buildup of assets of one particular type. Now, you can make excuses for not understanding the safety of this particular asset class, but it's hard to make an excuse for not charging any risk, anything against the risk budget of a trader for loading up on these things, as UBS, for example, the big Swiss bank, was found to have done. And it's also inexcusable that they had so much of these assets. Once these assets were trapped inside the bank and the housing bubble burst, as Michael described, now the banks were in a position where they didn't have enough capital. Just bear in mind that investment banks, for example, have been running at leverage of about 25 to 1, which means that for every $100 billion in assets, you only needed, or they were running at about $4 billion in equity. Imagine that $100 billion in assets goes down by $5 billion in value. That completely wipes out the $4 billion in equity. So a 5% drop in assets can wipe out a large, highly levered investment bank like Lehman Brothers. Now, of course, they weren't saying, we are underwater. It was left to all the other banks to guess. Should we lend money to Lehman? Or should we invest equity capital into Lehman? Well, maybe not, because we don't know what they're worth. And those of you who've taken economics know about the idea of adverse selection. You should never pay a price at which someone is willing to sell when they know more about what it's worth than you do. So no one would lend the money, no one would invest equity in them, and we had what is called a gridlock. The whole interbank market was frozen. And that's where we were a couple of weeks ago, and then the big ones started to fall. Well, Bear Stearns had already fallen several months ago, but in short succession, Lehman, AIG, and then Merrill Lynch was bailed out by Bank of America. And that set off a serious concern. What are all these other banks worth? And then it went to Europe and so on. And we found ourselves in a situation where, as opposed to Plan A on the TARP, the bailout plan, where the distressed assets would be purchased by the Treasury, we had to go to Plan B, which Paulson had originally rejected as a failure, which is Plan A is not going to work fast enough. These banks are viewed as unsafe. Investors are going to continue to panic in the stock markets until these banks have enough capital. So they went directly to Plan B, which was announced essentially yesterday, and you saw the reaction in the stock market all around the world. Stock prices went up by more in one day, essentially, than they have ever before. I mean, in some countries more than others, but on average across the world, essentially the best day ever in the stock market. Now, will Plan B work? Well, that has a lot to do with this this issue of gridlock in the credit markets. It's not really the stock markets that we should be looking at. I jotted down a few numbers on how the credit markets responded to that plan. So, for example, Goldman Sachs, which is one of the two remaining, former investment banks, Morgan Stanley being the other former remaining investment bank, last Friday, in order to insure yourself against default on Goldman Sachs for, say, $100 million of their debt, you had to pay about $4.9 million a year. Now, that's a very hefty premium. Normally, that would be a sixth or an eighth of that amount. Morgan Stanley last Friday was at $12 million on $100 million of debt. So that means that more than 10% a year of the debt itself you had to pay as a premium to protect yourself against default of that debt. That's an alarmingly high number. Now, we saw how the market voted in stocks today and yesterday. Goldman Sachs's credit default swap rate, which is what I mentioned, went down from 4.9% of notional to 3.2%. Morgan Stanley's hasn't gone down as much. It went down from 12.4% to 10.5% of notional. So that's still over $10 million a year to insure yourself on $100 million of Morgan Stanley debt. That is an extremely hefty premium, and if that doesn't come down quickly, it'll be read as news that, at least in some components of the financial sector, there's still concerns. We know about what's called a run on a bank. It's where all the investors start taking their money out, mainly because they're worried that other investors will take their money out first, and if they don't get there, then they'll be left at the end of the line and not get their money out. And the bank can fail merely because investors think that other depositors will run on that bank. Well, there's a phenomenon that happens in the backbone of the financial markets, which is essentially of the same type, except that it's not ordinary retail depositors. It's other banks that lend money in the overnight market. It's what's called repos, which is a form of lending collateralized. It's the money markets, which traditionally do lend in large amounts to the larger banks. And it's the prime brokerage accounts of these major banks. I had calls from, on the Wednesday that Merrill Lynch was purchased, I had a call from a hedge fund that asked whether I thought that they should try to get their money from their prime brokerage account with one of these major investment banks into a European bank right away, because European banks were viewed as safer at that time. And in fact, some of the larger banks lost a very sizable fraction of their prime brokerage business in very short order as hedge funds pulled their assets out of these banks. So again, with that kind of leverage, as people start withdrawing the funding, even if the assets haven't gone down in value, the ability to roll over that leverage becomes impossible unless the market is calmed and transparency returns to the market, so that I know what a particular bank's assets are worth. Once I know that, then I can lend to them. Or inject capital in them again safely. And the Treasury's plan was basically to short-circuit that process by just forcing them to take capital rather than having to look for it from their own investors. Now, there's a lot more to the mechanics of it, and we'll leave it to the question and answer period. I'll just go directly to Joe and hear what he has to say.
Great. Thanks, Darrell. Thanks, Mike. Now, look, it's obvious. These two guys, they have very, very big brains, okay? They understand a lot. I'm just a simple country lawyer, okay?
Right, Joe.
What do I know from all of this?
They're in your hands already.
So you know, let me just put up one simple graphic here. This is an early release version of a publication many of you know may see, which explains the situation. That's all you need to know. Okay? Now, you want to know, you know, I was in the meeting at the White House, all right, where Paulson is talking to Bush, all right, and Paulson goes in and he says, "Oh, fuck." And Bush looks at him and he says, "Oh." And Paulson looks back and Paulson says, "Oh, fuck." Bush's response is, Bernanke, meanwhile, is just sort of sitting there going, like, oh my God. But okay, let me try to. No, really, you can't get more eloquent than that. Well, you can, but it's not worth it. It's unnecessary. So let me try to put all of this stuff in some sort of coherent fashion. There's a not inaccurate analogy to a situation where a person doesn't take care of their own personal health. Let's suppose somebody gains 120 pounds in the course of 6 years, and then they wind up having a cardiac event that's actually induced by their weight gain. Well, you have to treat the acute problem, all right? You're going to have to do the bypass, but after you do the bypass, you still got the problem. You still got the extra 120 pounds. That's the chronic condition. So, the chronic condition stimulates the acute. We got to solve the chronic condition, the acute condition to save the patient, then we still have to deal with the chronic. Now let me tie this together. The chronic condition was very, very well explained by Professor Boskin. What we had was a tremendous run-up in asset values, most notably observable in residential real estate. For a wide variety of reasons, it was caused by low interest rates, which then gave rise to, in effect, mortgages that were free call options on the possibility that real estate values would continue to rise again. At some point, people simply say, we can't afford to pay this much for housing. All right? So the value of the housing then starts tumbling. At its peak, residential real estate was worth approximately $25 trillion in the United States. It's off by 20%, and it's going to lose more. That's taking $5 trillion off the balance sheet, all right, of the average American. Okay? Now, this is the chronic problem that we have. Now, in addition, that feeds into the stock market, where we've lost trillions of dollars more. If you have a look at the behavior of the typical American consumer, people's behavior changed because they perceived themselves as having additional worth in their home. Many people took out second mortgages. They took out second mortgages for noble purposes, such as sending their kids to Stanford Law School. All right? They took out mortgages for other purposes, like, summer vacation in Alaska so they can get a good look at Russia. Okay? But basically, at the end of the day, most of this stuff went for consumption. All right? It wasn't the kind of investment where we're building highways, we're building universities, where we're going to do something productive because of it. It was, more BMWs and more vacations and more Chateau Latour, all right, if you're into that. And now, also, people changed their behavior. People didn't save as much, all right, out of their paycheck. Why? Because they thought they already had their saving in the house. All right, when I retire, I got $300,000 worth of equity in the house. We'll sell the house, we'll move someplace smaller. I got $300,000 in the bank. Not. Okay? It's not there anymore. Now, the only way that you can actually deal with the health problem if you've gained 120 pounds is by losing weight. And there are only two ways to lose weight. All right? They are exercise more, which means you're going to work harder, and the American economy is going to work harder. It's going to be forced on a diet. Or consume less, which in my analogy means consume less. Okay? So we're actually going to have less that we're actually going to be able to take out of the economy this way. The analogy from that perspective is almost perfect. And as you force the American consumer to consume less, 70% of GDP is driven by the consumer, that leads into a recession. You have the same phenomenon in terms of real estate values, by the way, that's occurred in many other countries. Have a look at real estate prices in London. I don't know how many of you have tried to buy a flat in Mayfair, all right, last year or the year before. I just found I couldn't afford it. I mean, I could not live next door to the Queen of England. She was grateful for that thought when she stopped to ponder it. But prices in London are going to be coming way down. Prices in Ireland are down. Prices in Spain are down. Prices in China. All right, real estate boom over there, that's coming down too. Okay, so what we have is a global situation where there's been a tremendous loss, all right, in real estate values that's fed into the stock market. By the way, how much is the Chinese market down? Wow, approximately. 50%. About 50%. Indian market. Okay? It's you know, the U.S. stock market, as painful as it is to us, it's actually down less than many of the foreign emerging economies. So that's the chronic condition. Now, this chronic condition gives rise to an acute problem because the way Darrell talked about the plumbing of the system, and I think Darrell's exactly right, and I think it's a more fundamental point. I would propose for you that no civilization is greater than its plumbing. Okay? And what we had, as we had this decline in asset values, it caused a flush through the financial system that simply overwhelmed the plumbing capacity. And it overwhelmed, I know it's an ugly thought, if you think things were just backing up. People were flushing on the 24th floor and it was coming out on the 45th, all right? It was not supposed to work this way, but that's exactly how it was going. And in fact, this is one of the research projects that I'm working on now, that these problems gave rise to what's often called a crisis of confidence. And if you think about crises of confidence, they typically come about because there's an information failure. You don't know something. There's information you need, and you don't trust the other person to tell you the truth. So what we had was an information failure that was generated by a variety of factors. Let me just name 2 or 3. Number one, there's this accounting rule called FAS 157, which describes the way financial institutions are supposed to value certain financial instruments on their books. Well, when things get complicated enough, the accountants with a straight face tell you, go to level 3, FAS 157 accounting, which basically means ask the mathematicians to make up a number. All right? Now, Darrell knows a lot about how the mathematicians do this, and I think it's fair to say that there's a significant amount of subjectivity, both in the structural construction of the markets, of the models, and in the inputs you put into the models, especially in a situation where there's not a lot of trading of these instruments. So there are large variances about the models and the inputs. Is that fair?
The data weren't representative either.
Right. Well, that's a polite way of saying they were really making it up. Now, so here I am. I'm a bank, all right? And I believe that I've done a good job in my public disclosures under FAS 157. But my process of going through the FAS 157 process has emphasized to me how subjective the process is and how it could be that some of my counterparties aren't doing as good a job as I am. Am I going to trust my counterparty's valuation of these instruments? So even if you think FAS 157 is a good idea, and there's a big debate among policymakers as to whether it is or isn't, in many situations, I think it's fair to say that FAS 157 generates precisely the type of uncertainty that can cause markets to freeze up and cause people simply to say, I don't believe you. You say, you got $1 billion in those bonds? I go, I don't know. I told you I got $1 billion, but I know I could have said 800 million or 1.3. What do I know? So it can lead to a massive lemons problem, and I think it is structural in the operation of FAS 157, okay? Which is, I think, maybe the most fundamental critique of that rule in the environment we've run into. Other problems, the OTC markets, extraordinarily opaque.
How they handle Lehman and so on. Then they've been saying that they're going to be putting funds up for thousands of additional banks. And I just think that, from my experience at the RTC, where we're taking over failed institutions and shutting them down and selling off assets in bulk, that these are going to have to be done in a sensible way, quickly. The triage is going to have to be done sensibly. The capital injections are going to have to be large enough to be sizable capital for the banks so that they can have a prospect of surviving. So we're going to have to figure out quickly who's healthy, who's marginal but has a good chance of surviving, and who doesn't, who's so far underwater it makes no sense. And I think that's going to be very difficult in the political process, and I'm nervous about that. To repeat something Darrell said, just remember you're reading a balance sheet. You know, the investment banks were levered 25 to 1. The banks take a round number 8, 10 to 1, let's say. So it's not surprising that the firms went in inverse order of their gross leverage ratio. Bear, Fannie, Freddie, AIG holding company, the insurance subs were well capitalized. all were very heavily leveraged. Morgan and Lehman were next in the mid-20s, although they've taken some steps since then to raise capital and to convert to a bank holding company and commercial bank holding company, et cetera. So that's part one, is how this is done will affect not only the ultimate cost of the taxpayers, but actually the quality of the resolution of it all. Secondly, the Treasury's done a horrible job of explaining why the different parts are interrelated. They're making it look like they're throwing a whole bunch of darts, and they've wound up with this now as the grenade, following up a bunch of darts, and they're waiting to see what sticks. But actually, some of the various things they're doing are trying to help with discovering the prices of the things or the values of the things by the original idea of having a reverse mortgage, a reverse auction, et cetera, to buy some of these assets, try to get some price information to investors so that investors could sort out better who was solvent and who wasn't. Well, that's also information the people doing the triage, whether that's the Treasury or the private investors, need. And that's really important to do this well. The total amount at risk is immense, but it's the face value. So there's the $700 billion in these tranches that was recently passed. There's now the FDIC has unlimited, has basically an open checkbook and is now insuring money market, insuring bank deposits up to $250,000, and just insured all business non-interest-bearing deposits. You have the Fed and the Treasury having backstop many of these firms we've talked about and have a lot at risk there. Maybe not just what they've already put in, but more. We saw AIG had to come back for a second slice. The Fed is backstopping foreign central banks by offering interest on reserves. The Fed, which is a good thing, it should have done some time ago. The Fed is now setting itself up to greatly expand its balance sheet, which a year ago was $800–900 billion in treasuries. Now it's mostly in stuff. We're arguing beforehand whether the stuff's worth anything. The commercial paper stuff may be totally unsecured. Joe has a generous legal definition of collateral, a promise to pay as collateral, I guess. There are a whole bunch of legal issues.
If you're my client and that's the result you want, yes.
Okay.
That's right.
There are a whole bunch of legal issues of which will come out of this, and one of the things that I view as, no disrespect to all of you, not entirely healthy, is I think this is going to create a bonanza for lawyers for a while. Two last points. This really is a global phenomenon. And for those of you who think it's primarily Wild West American capitalism, or hear that from your European friends or from others, the same issues were going on. Britain had a worse housing bubble than we did. Spain, France, etc. had horrible housing bubbles. Same kinds of problems. The Landesbank are in deep trouble in Germany. This isn't just because of what happened here. Yes, some of them invested in our mortgage-backed securities. But they had a lot of things that were going on in their own economies, their own financial systems and the like, where they were doing similar things of borrowing short, lending long, which is very profitable, highly leveraged, as long as that game continues. But as Daryl said, when asset values fall a modest amount and you're very thinly capitalized, you're wiped out. Last point I would make is, for those of you who believe that it's as simple as regulation versus deregulation, as I said earlier, it's partly government social engineering, and we can ask what the next government social engineering thing trying to force something on the body economic that is not sustainable commercially over the long term will be. I have my own favorite candidates, but you should think of that. The regulation was outdated in any event. So there was some deregulation, some silly deregulation. The FCC, your former buddies, Joe.
I'm a recovering regulator.
In order to keep the Europeans from regulating investment bank holding companies, the FCC had only had jurisdiction over the brokerage subsidiaries, brokered a deal where they started regulating the investment bank holding companies, parent companies, but allowed them to greatly expand their leverage. So there's a long list in all sorts of administrations, Democratic, Republican. You can go back to the expansion of Fannie Mae and the protection of Fannie Mae, which was had immense leverage, forcing Fannie Mae to do stuff. Right now, the Treasury's offloaded some of the buying of mortgage stuff onto Fannie and Freddie, which is buying about $20 billion a month. So that's in addition to the $700 billion. So we don't know what the total cost would be, but that's the face value. To give you an idea, not that they're necessarily comparable, the Resolution Trust Corporation acquired well over $500 billion of assets in the S&L resolution. Sized to today's capital market, that would be, well, it's an issue what today's capital market is, but it would be more than double that, over $1 trillion. And the ultimate cost on the RTC side was about $100 billion. There was about another $100 billion or so that occurred prior to the RTC through the Federal Home Loan Banks. So you can't just look at the face value, but this could cost a lot or a little. It could work or not. Darrell, in a previous thing, you used a great line that this is a theory that this will work, and we're going to run it once and see what happens. But in any event, we really don't know what the ultimate outcome will be. But if we're really going to be worried about the cost to the taxpayers as the main thing, it seems to me we're taking our eye off the ball. That is important, but it is only one of the important things. It's the health of the economy and the economy's ability to grow long term. I've often said there are two times that are dangerous for making economic policy: when the economy is booming and everybody thinks everything's affordable with naive extrapolations of these growth rates, we pile on these programs and not worry about how much they'll cost later. And the other is in times of crisis where there's a need, often partially successful policies are enacted, but they can have deleterious long-term consequences. So now we're hearing everybody say this, we're hearing some people say this is the end of capitalism. We now have to bail out Main Street, autos and airlines are next, and we're going to keep going, and this is a preliminary warm-up act for a huge expansion of government in our economy. So if you think a 2-year recession with GDP falling at 2 or 3% a year is ugly, which it really is, far worse than anything we've experienced since the early 1980s, imagine moving to French GDP per capita with their level of government and the economy and taxes and spending, where we have a permanently 30% lower standard of living, not than today, but what it might be when you're out there in your peak earning years. So those stakes are high, too, how we come out of this, and what we do out the long term about what our policies look like and getting the government out of the parts of the financial system it doesn't need to be in and the regulation it doesn't need to do. Okay?
So I'll be very brief, and then we'll go to questions. In fact, well, just an observation, then I'll start with a question for Darrell. First, the observation that it would have been better to get co-investment, yes, absolutely right. In fact, the Treasury knew that and the lawyers knew that. But their response behind the scenes basically was, look, there was a concern that you wouldn't be able to get enough money from the private sector to come in. That's number one. Number two, even if you could get the money to come in, we don't have the frigging time. Did you see what the stock market did on Friday? 1,000 points. If we don't have everything lined up, and if we can't bring confidence back to the credit markets and the stock markets by Monday, who cares what we can do by Friday? We may not be around by Friday. All right? We got to have this heart beating by Monday. So even if you think there is enough money in the private sector and that KKR and Blackstone and everybody else would be willing to pony up, we don't have enough time to negotiate the deals by Monday. And then suppose we try to do this and we fail. Oh boy. Okay, do we want to try to do this and then learn that you can't make that market work, you can't close it? We don't want to run that risk. So when Treasury looked at the co-investment alternative, there were 3 schools of thought arguing no, no, and no. All right, and the one that was the easiest one to persuade was there's just not enough time. Even if you think it's a good idea and if you think it can work, we can't engineer it that quickly. Let me start the Q&A with the question for Darrell. I sort of look at the global markets, I look at pricing, and I see this unbelievably remarkable disconnect between equity values and debt values. The debt markets are signaling that the ice age is coming, that we're headed towards something that looks like the last Great Depression, that bankruptcy rates and failures are going to be well beyond anything that we're looking at. And if the debt markets are right, equity market valuations are much higher than they could rationally be. These two markets are sending very different signals. And, if one were a trader, one, I think, would be enthusiastic about buying low and selling high. You'd, buy a bunch of stuff in the debt market and short the equity market. Is my perception wrong? What's going on over here?
This is one of the biggest puzzles that even preceding the credit crisis in the empirical research on credit markets. Why don't they follow equity markets more closely? Because you probably all seen the theory. It goes back to Black and Scholes and Merchant, that allows you to value the equity of a firm as an option on the assets. In other words, all of those assets are going somewhere. First they go to the debt, whatever's left goes to the equity. So when the assets go down, both lose, and they should lose in a way that's in some sense proportionate, at least in the short run. And all of the empirical evidence, which is considered a big puzzle going back 10 years of literature, has found that those markets are not in sync. There's high segmentation, because those that trade in the credit markets are different people with different pots of money, different risk limits, different reasons to trade than those trading in the equity markets. And they're out of sync. And it was one of the big puzzles over the last year. Why were the stock markets so calm until recently, and the credit markets were just in a sheer panic with interest rates, the interbank interest rate market, 300 basis points at times above overnight interest rates.
So what you've done is you've asked my question in a much more intelligent way. I told you he had a big brain, but you haven't answered it yet.
So are you asking why? Or are you asking, was the stock market overvalued?
I'm asking two questions. Why? And doesn't this mean that I should short stocks and buy debt?
No, because I don't know which of these two markets is correct.
But they can't both be right. That's my point.
You can repackage them and try to short the whole firm, but that's not easy either. There's just no arbitrage on this. I'm sorry, Joe. I'm not going to be able to make a lot of money for you. And as to why it is, it's another example of inefficient markets.
Right. Let's go to questions.
Maybe no asking personal financial advice.
There are microphones here and here. Maybe you want to identify
if you could just step forward so that we can record your questions for posterity.
Right. And
if there is a posterity, given the way the markets are behaving.
Please also identify yourselves and maybe indicate whether you're from the law school or wherever.
I'm a little scared because I seem to be the first guy.
Don't worry about it.
I'm Gopal Dometi, and I'm in public policy. My question is, just looking at the coupling of all the various countries, what's the future of dollar as an exchange currency? And in the long term, what do you see the impact of this to the dollar?
Well, let me say, even before the current turmoil, the star trader at Goldman Sachs on the currency desk who made $50 million a year or whatever it was correct 53% of the time. So I think it's presumptuous. There are a lot of theories about exchange rates outside the short-term movements, but their purchasing power parity, trade balance or current account balance, equilibria, capital market issues, and there's no convincing analysis that holds up. They seem to diverge from what people think are fundamental values for very long periods of time. They perhaps overshoot even more often than other markets. That being said, I think the notion that the dollar was going to quickly vanish as a reserve currency or the euro would quickly move into parity were exaggerated. But I think as there are others, still most transactions, say, between New Zealand and Malaysia firms in New Zealand and Malaysia are transacted in dollars or invoiced in dollars. So I think that slowly we would expect the euro to become more generally accepted. Increasingly, people will be comfortable about diversifying into more than, out of the dollar into more than one hard currency. But I think it's a very slow process. I myself am very pessimistic about Europe long term. I think the combination of the welfare states being so bloated and their much more difficult demography than the United States will make it very difficult for them to grow at any reasonable rate, barring a massive change in attitudes towards immigration, which I think is less likely there than here. So I think in that sense that can't, other things being equal, that can't be good for the euro versus the dollar. But I personally don't play currency markets.
I think we have another question here.
My question involves the sovereign wealth funds, both with China, with its current account surplus, and then the petroeconomies building up dollars. I know they're nowhere near the central cause of all of this, but I'm curious on what kind of effect they've had in the accumulation of all this debt, because as Professor Grunfest was saying, my name is Blake and I go to law school, is if we've gained an extra 120 pounds, it's because, or one of the reasons that's been put forth is there have been currency manipulations that China has been building current account surpluses and then investing it in, and it's hard to lose weight when someone's offering you cheap food. So I was curious if there had been much analysis or thought, or is there just too many other bigger problems that this is something...
Whatever one views the proper ratio of the yuan to the dollar, there's some people who believe that by artificially keeping the band pegging and then keeping the appreciation band small, that it should appreciate more. That's got to be a trivial fraction of our overall current account balance, or China's surplus, or even our bilateral trade issues with China. Our current account balance primarily reflects the fact that we, as Joe indicated earlier, have a low saving rate relative to our investment rate. As Ben Bernanke put it, there's been a saving glut around the world relative to investment opportunities. There's people who have clamored to invest in the U.S. because, as they used to say, we're the largest economy, we have the best prospects for growth among any of the major economies, and we have the largest, most liquid, most transparent capital market. Used to be part of that story. So my view is that what you're calling currency manipulation, whatever the verities of it all are, it's a small part of the issue. We've been a current account balance, if you remember your introductory economics, a large current account deficit, a need to import capital to finance the domestic investment above our own saving financing it, is a reflection of the fact that we are consuming more than we are producing as a nation. You can do that for a while, but eventually the present values have to equalize. And we're paying a price for that right now. Now, it's good to have foreigners lend us money on good terms. That's great. Imagine if they didn't. Would you have rather had them not lend us money? Would you rather have not invest in the U.S.? That would have been very difficult for us. However, it would be better still if we saved more over time. Right now is probably not a good time to be trying to push a big increase in the saving rate given the recession we're entering. But over time it would be better if we saved more and financed our own investment.
Could I just quickly follow up on Michael's answer? There is one connection that shows up in the nitty-gritties of the asset management business. With such a large demand for U.S. government bonds, we, the United States, were able to borrow a large amount of money and still have relatively low yields for U.S. bonds. The asset management business, and I'm sure that some of you here in this room are involved somehow in the asset management business, offers its investors yields which investors like to compare to, the yields that they had been getting in the past or the yields that they might otherwise get. And the reaching for yield is the phrase that's used that occurred during the last 10 years or so might not have been so severe had U.S. interest rates been much higher. That reaching for yield, meaning try to get something more than a few percent on treasuries, which is all they're available because the Chinese are buying so many, resulted in a high demand for securitization assets. So CDOs of this senior sort that were supposedly safe were earning yields somewhat higher than treasuries. And because treasury yields were so low, there was a very large appetite to buy those CDOs, which feeds into that vicious circle that we talked about earlier, where homeowners were able to get loans on pretty easy terms because there was such a high demand for so-called safe CDOs yielding a little more than treasuries and supposedly having only a little bit more risk. So that connection, I think, would be there.
Yeah. And that also fits in with the nature of the problem we have, because there was a lot of hidden optionality in much of the additional yield. In other words, you got paid an extra 15, 20, 25 basis points, but you never get something for nothing in the financial markets. And you are getting paid that extra 15 basis points because in the low probability event that something bad happened, you could lose a lot. Well, the low probability event is here, my friends, and you're paying up big time for those extra 15 basis points you got in 05 and 06. You're now losing half your money because you wanted an extra 0.25%.
A less extreme example of that, but a good one, is the money market fund that got all the publicity for breaking the buck, reserve fund, had yielded over 4% for the previous year at a time when money market funds were yielding, 2%. And so how were they doing that? Well, they were heavily into things like Lehman. And probably most of you have not looked at your money market funds and read all the fine print and realized that whatever the headline investment is, that many of them have things that they can invest up to X% in anything or some set of things that are riskier. That's how they get the extra yield that Darrell was talking about.
Is there a question on this side of the room?
I'm John Kimball. I'm a second-year law student, and my question is for Professor Boskin. I mostly just wanted to take issue with some of the way you characterize the economic history of the market, in that you began the story with a federal government decision to support low-income home ownership, whereas Professor Duffy characterized it more as being driven by securitization. And that seems to me to be more accurate. Beginning in the 90s, that this is the subprime market and sort of its excesses, and the crazier loans that are failing at tremendous rates, the hybrid option ARMs and the NINA loans, were created by subprime lenders in response to investor demand, not in response to Fannie Mae or Freddie Mac pressure. And while Fannie Mae and Freddie Mac began buying risky loans, subprime loans, they were sort of the least risky of the worst kind, and they came later in the game after the market had already exploded. I guess the point I'm trying to make is that federal housing, subprime lending has never been about creating new low-income homeowners. Like, only 10% of the market is first-time home buyers getting purchase loans. Most of it's refinance lending. And I think it's the trouble, the danger in characterizing this as a consequence of social engineering is that you're scapegoating policy that A, wasn't there, and B, could have been done responsibly, and we might not approach it again responsibly because it's gotten this bad rap.
Well, you're welcome to your opinion. I thought I very carefully said that there were a series of these things that mutually interacted as accelerants, including the securitization process. So I didn't mean, if you interpreted me as saying there was only the government policy, that was far from what I had in mind. But there are many things that went on. The Community Reinvestment Act was enacted in 1977. And banks were continually through that and a variety of other things were pressured into lending in ways that were considered to be, to avoid problems given their bank charters, especially those with federal bank charters. So there are a whole bunch of these things that cause problems. I've only touched on a few, but I certainly agree that securitization was a big part of this. The demand for those products was a big part of it. But you certainly weren't going to have low starter teaser rates with 5% interest rates rather than 1% interest rates. Okay, so I think federal policy had a lot to do with what happened. I think they interacted.
The Community Reinvestment Act actually didn't apply to most of the subprime lending industry. They were mortgage finance companies. They're not depository institutions. And so the majority of them had no regulatory pressure from CRA. And the CRA
it grew over time, sir.
CRA also only had predatory lending provisions in it. So banks, in theory, would have been penalized for bad underwriting standards if CRA had been properly enforced. But the reality was that CRA was toothless and never had a very little influence over almost all banking activity. It was only triggered during mergers.
You're entitled to your opinion, but I think that the banking community would have a different opinion than you and different people depending on who talked to with the Federal Reserve.
Has an interest in gutting this regulation and is falsely scapegoating.
You're welcome to your opinion. It's hardly the only thing that contributed to it, as I said, and you're welcome to your opinion, but I happen to think that you're minimizing the impact of the social engineering.
My name is Paul Vronsky. I'm a former student of Professor Grunfest. My question goes back to a point you had made earlier about the litigation that could come out of this, and I guess specifically to the lawyers on the panel. What do you see as the trigger in the legislation that would perhaps, and I'm not talking, say, about the Citibank litigation that's going to be going on right now about what one word or another means, but later on down the road when we have the shareholder class actions, is there anything in this litigation that could be potentially expansive to that? And then second follow-up to that, do you see this having any impact on the rollback that we've seen in previous years of 10b-5 litigation? Are the courts now going to be more reticent in stopping shareholder litigation in light of the sort of quote-unquote excesses and the like? And sort of what do you see in the future for shareholder class actions?
Well, yeah, I'll just respond two parts. Number one, you say, what about the possibility there will be litigation? What do you mean possibility there will be? It's already here. The problem that the plaintiffs' lawyers are having is that they've run out of people to sue. You see? Just about every investment bank or, significant publicly traded financial institution that's had a significant stock price decline has already been sued. And their directors have been sued, okay? And anybody that's underwritten any instruments for them, they've already also been sued. So the only thing they can do now is, as the stock continues to go lower, they file an amended complaint saying, you thought you owed us a lot of money last week, well, you owe us even more now, okay? So what's really intriguing is to read the plaintiff's complaint. Everything that's going on in the world is caused by management fraud. Well, we know that that's wrong, okay? We know that there was fraud. We know that there was bad fraud. But it is impossible, all right, that so much of the problem is caused by fraud as plaintiffs' class action attorneys say. Now, what does the current situation mean for the future of legislation in the securities litigation area? Well, I'll make a real simple prediction. It doesn't make a difference who wins the presidential election. There almost certainly will be legislation that will be viewed one way or another as being pro-plaintiff in the space. If Obama wins, the legislation will come faster and will be broader. I can speculate, and it would just be speculation, about